This week, we are going to look at the subject to tax rule as it has just been published by the OECD, the Multilateral Convention thereon. Now, what you see on the right is a guideline which was published in July on the STTR, and then we got the Multilateral Convention to facilitate the implementation of Pillar 2 subject to tax rule, which came out in October. And with it was also an explanatory statement to the Multilateral Convention, and it largely follows what the other two documents are saying. Although it must be said that the explanatory statement has some minor differences with the Multilateral Convention itself. I'm not quite sure whether this will be fixed in time, but let's have a look at what it says. Just for background information, the OECD came with this publication on the 3rd of October, where they said the inclusive framework on BEPS has concluded negotiations on a multilateral instrument. The convention, which is now open for signature under Pillar 2, right? The STTR allows source jurisdictions to impose a tax where they would otherwise be unable to do so under the provisional tax treaties. The new multilateral instrument will allow countries to efficiently implement the STTR into existing bilateral treaties. And I think what they refer to here is the theoretical discussion on the multilateral instrument for under BEPS Action 15, whether that was part of a treaty like a protocol or whether it was on top of a treaty. And then they say the OECD is also preparing a comprehensive action plan to support swift and coordinated implementation of Pillar 2 with additional support and technical assistance to enhance capacity for implementation by developing countries. So what we're going to do is we're going to look at a practical example of payments, and then we're going to see how the different rules from the treaty will apply to these payments, both under an interest payment scenario and under a service fee scenario. And then we'll also look at how this interact with the income inclusion rule and the UTPR, the under tax payment rules. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. Now, just to give you an idea of what the Multilateral Convention looks like, it starts like any other one. It has Multilateral Convention title, and it's got an introduction to the parties of this convention, have agreed as follows, etc., etc., and then goes to part 1. It says what the scope of the convention is, an interpretation of terms. Looks very much like the OECD Model Convention as well. The double lines, black parallel lines, which just means that I've left parts out. And then you come to part 2, and this is the interesting part, because most of the treaty is actually in the annex, right? So you see Article 3, inclusion of Annex 1, the subject to tax rule in a covered tax agreement. Annex 1, the subject to tax rule, shall be included in all covered tax agreements and shall form an integral part thereof. Again, it's not something that's bolted on top of the treaty, it's part of the treaty. And then if we look at Annex 1, you can see it's a subject to tax rule. It starts with a taxing right in a jurisdiction where the covered income tax is below a minimum rate. So it basically says, you know, if the recipient is paying less than 9% tax, then the payor can levy an additional tax. But then it says, you know, it cannot be bigger than the difference between the recipient tax and the 9%. So if the recipient is paying 4% tax, then you can only levy 5%. But you also need to deduct from that withholding taxes and these kind of things they discuss further. So let's look at what the rules themselves say with regard to specific examples. So here is our structure. We've got an ultimate parent entity, and we've got a creditor company that pays 4% corporate tax, and we've got a debtor company that pays 20% tax, and there's interest of 1 million paid from debtor co-country to creditor country, and the withholding tax under the treaty is 2%. Now, this is not realistic. Normally it's 5% or 10% or 15%, but we need to work with the 9% maximum tax under the STTR. So let's make this 2%. And then credit co is also paying interest to a bank of 200,000, right? So under debtor co-country, the way the STTR works is Article 11.2 of the debtor credit co-countries. So the normal treaty says there's a 2% withholding tax on interest, right? So Article 3 of the STTR, multilateral instruments, then says Annex 1 that we just looked at shall be included in all covered tax agreements and shall form an integral part of thereof. We saw that in Annex 1, Article 1, Paragraph 1. Article 1 is very long. It has 15 or more paragraphs. Says, where in accordance with the provisions of this agreement, in other words, Article 11.2, that provide that interests arising in a contract state shall be taxable only in the other contracting jurisdiction, or that limit the rate at which such interest may be taxed in the first jurisdiction, in other words, only to 2%, and the tax that may be charged in the other jurisdiction is limited. That income may, notwithstanding the tax in that jurisdiction, if it is subject to a rate below, may be taxed in that jurisdiction if it is subject to a tax rate below 9% in the contracting jurisdiction of which the person deriving that income is a resident, right? So Credit Code pays 4% tax, it's less than 9%, and therefore we may now levy under the STTR under paragraph 1.1, and then paragraph 1.2 says, however, the tax charged in accordance with paragraph 1 shall not exceed the specified rate multiplied by the gross amount of the covered income. Right? Now note here the word gross amount, right? So this is a income on the STTR's income on gross, tax on gross income, not net income. The specified rate that we just talked about is equal to the difference between the 9% and the tax rate determined in accordance with paragraph 5, and this is this 4% that's levied in creditor country. So the specified rate for the time being is 9% minus 5% gives you 4%, but then you have to deduct from that also the withholding tax, and we'll see that in a moment, of 2%. So Article 1, Paragraph 5, for the purpose of this article, the tax rate is the statutory rate of tax, and the statutory rate of tax in credit country is 4%. Now, going a little further, there is Article 1.3. Article 1, Paragraph 3, which says, where in accordance with any other provision of this agreement, the gross amount of the item that covered of covered income may be taxed in the contracting jurisdiction in which it arises. So, in other words, debtor country, at a rate that is lower than the specified rate, and we've already said the specified rate is 5%. That other provision shall continue to apply, and the specified rate shall be reduced by deducting such lower rate. Right? So the specified rate is 9% minus the 4% paid in credit country. That's 5%. But now, since debtor country can already levy 2% withholding tax on interest, that 5% is further reduced by the 2%, leaving us with 3%. Right? So, and then there's also paragraph 12. I've said Article 1 is a long article, which says, the provisions of paragraph 1 and 2 shall not apply to an item of income of covered income derived by the tested payee unless the sum of the gross amount of covered income paid is more than 250,000 euro in the fiscal year, and where one of the contracting jurisdictions, not the debtor, but one of the contracting jurisdictions, has a gross domestic product of less than 40 billion. Now, we'll assume here that debtor country has less than 40 billion, and therefore the threshold is 250,000, which means that if the interest paid from debtor to creditor was 249,000, there would be no STTR due, but if it was 251,000, then there would be STTR due. And then if we look at our calculations, the income source in debtor country is 1 million. The specified rate is 9% minus 4% minus 2%, like we just said, so it is 3%, and the tax charge in debtor country will be the 3% multiplied by the 1 million, which is 30,000, and then Annex 1, Article 114, the tax chargeable, this is about when this can be levied, right? The tax chargeable shall be determined following the end of that fiscal year and shall not be levied by the first mentioned jurisdiction until it is so determined. And the reason why you only calculate the STTR at the end of the year is because you need to look at the aggregate payments from all related parties, both in creditor country and in debtor country. And you need to see whether it goes over this 250,000 euro or 1 million euro threshold, and you need to see whether the taxes due is less than 9%, and you need to consider all the withholding taxes, etc., etc. So you really have to wait until the next year. Now, if we look at the creditor country, then there's a bit of a mismatch between the treaty and the commentary. If we look at Annex 1, Article 115, so here's a multilateral convention, and you can see paragraph 1, Article 1, paragraph 15 of Annex 1 says the application of provisions of this article shall not create any obligation that require a contracting jurisdiction to, and then jumping to letter A, exempt from tax income derived by a resident of that contracting jurisdiction, which may be taxed in the other two contracting jurisdictions in accordance with the provision of this agreement, or provide a deduction or credit in respect of taxpayers with respect to the income derived by a resident of that contracting jurisdiction. And this is taking the STTR payments out of Article 23. So you must give double tax relief for income that is normally taxed, dividends, interest, royalties, whatever you want. I mean, according to Article 23A or B, but you don't have to give double tax relief for the STTR payments, because that would defy the whole object, right? Because the whole idea is to increase your total tax rate, and if you were going to get a credit from that in the bad jurisdiction, if you want, because they are below 9% tax, that would justify the whole object of the exercise. Now, if we look at the explanatory statement, it explains paragraph 15 a little different. It says that you will have new paragraphs added onto Article 23A and B. It says the same as paragraph 15 here above, but it says it as add-ons to Article 23A and B, not just standalone paragraphs. So let's see what happens in STTR, right? We've got the interest, withholding tax and everything, and now in creditor-co. But we've just talked about Article 1, paragraph 15 of Annex 1, which says that there will be no double tax. So if we look at the calculation of tax for creditor-co country, it earns $1 million in interest income. There's 200,000 that is paid to the bank. So its taxable income is 800,000. 4% of that is 32,000. Now there's already 2% withholding tax paid to debtor-co country, interest withholding tax under Article 11.2 of the treaty. So let's assume that creditor-co country is a credit system. So it gives a credit for that 20,000, and then it gives 0 for the 30,000 that is paid in STTR, and the total tax due in creditor-co country is then 12,000, right? And then this is so if we look at the total tax paid is 32,000 in creditor-co country plus 30,000 STTR in debtor-co country. That's 62,000, and 62,000 out of 800,000, which is the taxable income in creditor-co country, gives us an effective tax rate of 7.75%. Now, if we look at what happens in the UPE country, we need to do some income inclusion rule calculations. Now, first of all, we'll calculate our adjusted covered taxes, and under 421A of the Globe rules, we need to look at the taxes from the financial accounts. And I will assume here that creditor-co has 32,000 in its financial accounts, being the 12,000 that it pays in creditor-co country and the 20,000 withholding tax that it got a credit for. And since these are in the financial accounts, I assume that we will not know what the STTR are yet by the time the financial accounts are published, right? And then we get to 421C of Globe rules, and this says that you add to the covered taxes also any taxes in lieu of income tax. And the commentary in paragraph 31 to Article 421C specifically mentions STTR, right? So we also add the 30,000 under the STTR, and then the total adjusted covered taxes comes to 62,000. Now the net Globe income, we will assume, remains 800,000 like we looked at before. We will assume there's no substance-based income exclusion, there's no loss carry forwards, there's no minimum, the de minimis exception does not apply, right? This is not 1 million but 100 million, and there's no negative tax expense or loss carry forwards, or all those kind of things, tax credits carry forward, etc. at play. So the UPE really needs to pay, and then the effective tax rate, as we already calculated on this 800,000, is 7.75%, which means that the top-up tax percentage will be 15% minus 7.75, gives us 7.25%, and that multiplied by 800,000 gives us another 58,000 that needs to be paid in the UPE country. And then the total tax will then be 50,000 in debtor co-country, 12,000 additional tax in creditor co-country, 58,000 in the UPE country. It comes to a total of 120,000 in tax over this 1 million, over 1 million minus 200,000, and then the effective tax rate, as we can see, comes to 15%. Of course, one interesting question is, how does this work timing-wise, right? Because we already have the STTR data and payments, etc., available by the time we need to file the income inclusion rule income for UPE? I'm not quite sure whether this will always be in sync or whether one would have to work with some carryovers and carrybacks with regard to this taxes or these taxes. So if we now flip the scenario and we say that creditor co actually pays 800,000 in interest to the bank out of the 1 million that it receives, and let's see what happens. You know, debtor co-country remains taxed on gross income, right? Because the withholding tax on the interest is gross income tax, so that is going to be 2%. The STTR is a tax on gross income basic in principle, so that would be 3% on the 1 million. So the debtor country tax will remain 50,000 out of the 1 million, right? However, the credit co-country tax will now be 1 million minus 800,000, which gives you 200,000 in taxable income, multiplied by 4%, which gives you 8,000 in tax, minus the credit for the withholding tax paid in debtor co-country, which was 20,000. So in credit co-country, the corporate income tax due will be 0, right? And if we look at the UPE, the effective tax rate is 50,000, which is paid in debtor co-country, over the net income of creditor co, which is 200,000. So that is effective tax rate of 25%. The top-up tax is only due if you pay less than 15%, and since 25 is bigger than 15, the top-up tax due for UPE will be 0, right? And now if we play with the same scenario, but instead of a interest payment of 1 million, we now have a service fee of 1 million, and we've got direct and indirect costs related to that service fee of 800,000. What happens is there's a new element introduced when the payment does not concern interest or royalties, and that is if we look on article Annex 1, Article 1, Paragraph 9, it says, which is a markup threshold, it says the provisions of Paragraph 1 and 2 shall not apply to payments made in consideration for, and then it gives a whole list of everything that's not interest and royalties, including any income received in consideration for the provision of services if, not to the extent that, but if, the gross income of the item of covered income does not exceed an amount equal to the costs incurred that are directly or indirectly attributable to the earning of that income, plus a markup of 8.5% on those costs, right? So if you pay a markup of, or if you charge a markup of 8.4%, there is no STTR. If you charge a markup of 8.51%, there is the full STTR that is due. So the STTR is a tax on gross payment. We need to remember that the threshold plays no further role in determining the STTR amount, right? So now we've got net income of 200,000. A markup on cost is 25,000 because it's 200,000 over 800. So it's way above the 8.5%. So STTR is due. The country debtor country STTR will come to 9% minus the 4%, including the withholding tax, so it comes to 50,000 as we calculated before. And then the credit country tax due will be 0, and the UPE country tax due will be 0 because the effective tax rate is more than 15%, right? Of course, what this does cause is a very strong cliff effect because, again, as I mentioned, you know, if the markup is 8.4%, there's no STTR. It's a markup, and then you only have the 20,000. You've got no withholding tax. Sorry, and if the markup is 8.51%, then you've got this whole STTR of an additional tax of 5% falling on top of the service fee. And the question is whether this is correct, but if we look at the additional guidance and the frequent answers and questions and answers from the OECD from October, it says the markup threshold focuses the rule on payments where the tax at risk and incentives of 8.5%, where the tax risk is more material. In other words, larger than 8.5%, and it then very specifically says. This feature of the rule was developed to balance the broad scope of covered payment and especially the inclusion of all intragroup services taxable on a gross basis, right, with consideration of proportionality and administrability. So yeah, you really want to stay below the 8.5%. And then finally, I just want to look at how the STTR plays with the UTPR. So we'll go back to our original scenario. We've got 1 million in interest paid from debtor-co to creditor-co. Debtor-co has 20% corporate tax and it has UTPR rules. Creditor-co has 4% corporate tax. It has no UTPR rules, and the UPE has no income inclusion rules, nor does it have UTPR rules, right? So what you see here is we assume there are no other subsidiaries in this group and no other countries involved. You can see that the debtor-co country can end up in a situation where it can collect both STTR from creditor-co and it can levy additional top-up tax from debtor-co because UPE and no one else in the group paid any IIR, right, or income inclusion rule top-up tax. So debtor-co country has withholding tax of 20 and STTR of 30, so there's 50,000 due. Total tax in credit-co country is 12,000. The top-up tax, as we calculated before, comes down to 58,000, which should be collected in the UPE country, but the UPE country does not have an income inclusion rule and it has no UTPR. And now you need to allocate the income between all the UTPR countries. Now, since we only have one UTPR country here, that is going to be, we're going to take 50% of all the employees that are in UTPR countries. That is 100% of debtor-co employees, and the same for tangible assets. That will be 100% of debtor-co tangible assets, because there are no other companies in our group which apply the UTPR. So debtor-co country will get 100% of the UTPR allocated to it. And now remember, the UTPR works a little different, right? Because the top-up tax, which should have been collected by UPE, was 58,000. UPE did not collect it. Now, in order to come to 58,000, we need to look at the effective or the tax rate of debtor-co country, which is 20%. We need to divide 100 by 20, which gives you 5, which means that debtor-co country can add back an additional 290,000 to debtor-co's taxable income, presumably in this particular instance by saying, you know what, that 1 million interest that you paid, 290,000 of that will not be deductible, right? And the 290,000 that's not deductible then at 20% tax leads to an additional tax of 58,000, which is the top-up tax under the IIR. Now, if we look at the total picture, you know, if there was no UTPR and no STTR, then debtor-co country would have allowed a deduction of 1 million times 20%, that's 200,000. It would have recuperated 20,000 in withholding tax, so it would have lost 180 in revenue. But now it gets 20 in withholding tax, 30 in STTR, and 58 in UTPR, which comes to 108,000, right? So it is 72,000 better off than it would have been without STTR and UTPR. That is it for today. I hope you enjoyed this explanation, and next week we will be back discussing some more cases. I will discuss the STTR in more detail in my online tax course in international tax. Bye for now.